Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamilton, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into a very pertinent topic, the recent Bank of Canada rate decision and its impact on mortgage renewals. Janine, it seems like the Bank of Canada's decision to hold the interest rate steady is offering little relief for those looking to renew their mortgages.
That's right, Steve. Many Canadians were hoping for a rate cut that would ease their financial burdens, but unfortunately, that was not the case. The rate hold can be quite challenging for homeowners, especially those who are already feeling the pinch of high living costs.
Absolutely, Janine. From a numbers perspective, homeowners renewing their mortgages at these rates might face higher monthly payments than they anticipated. It's crucial for them to reassess their budgets and prepare for these changes.
And let's not forget the emotional aspect, Steve. For many, their home is more than just a financial asset. It's a place of comfort and security. Facing higher payments can be stressful and may impact their overall well-being.
Indeed, Janine. It's a balancing act between managing finances and maintaining that sense of home. That's why it's so important for homeowners to stay informed and consult with professionals who can guide them through these turbulent times.
Absolutely, Steve. And speaking of staying informed, there's more real estate news to cover, including our Home of the Week feature. It's always exciting to see what's happening in the market and how it might inspire our listeners.
The Canadian economy has hit a bit of a snag, Janine, with the latest Statistics Canada data showing a contraction for the second consecutive month in May. The gross domestic product declined by 0.1%, matching the agency's advance estimate and following a similar decline in April.
That's concerning, Steve. It seems the wildfires have had a significant impact, especially on the oil and gas sector. Temporary disruptions in oil extraction were a major factor behind this pullback, according to Royal Bank of Canada economist Abby Hsu.
Exactly, Janine. Non-conventional oil extraction dropped another 3% in May, which contributed greatly to the overall economic contraction. However, it looks like there's a silver lining as production likely rebounded once facilities resumed operations after the wildfires.
That's good to hear, Steve. And it's not all bad news. Manufacturing output rose by 0.7% in May, and transportation and warehousing increased by 0.6%, both recovering from declines in April. Abby Hsu pointed out that this helped ease the broader downturn.
Right, Janine. Goods-producing industries were the main source of weakness in May, while service-producing industries remained relatively stable. And let's not overlook the real estate sector, which posted gains thanks to stronger home resale activity.
It's interesting to see how different sectors are performing. The retail sector, however, fell by 1.2% in May, almost reversing gains from the previous 2 months. Yet, RBC expects this weakness to be short-lived, with preliminary estimates for June pointing to a 1.6% rebound in retail sales.
That's right, Janine. Statistics Canada's advance estimate for June GDP indicates a modest 0.1% rebound, driven by increases in retail and wholesale trade, which offset some pullbacks from manufacturing. While these estimates are prone to revisions, they are a positive sign.
Despite the slowdown, it's reassuring to hear that the quarterly growth is still tracking a 0.1% annualized increase, even though it's much lower than the 2.2% growth in the first quarter. It's higher than the 1.5% contraction assumed in the Bank of Canada's scenarios from April.
Indeed, Janine. Trade policy remains a key factor in Canada's economic outlook. The influence of external trade dynamics, especially with the United States, is significant. However, Canadian goods exports to the U.S., still benefit from the CUSMA provisions, which exempt most goods from tariffs.
It's a complicated picture, Steve, but RBC expects Canada to avoid a recession and achieve modest, gradual growth through the end of the year. That would certainly be a relief for many Canadians.
All right, Janine, let's shift gears and talk about some of the top Canadian auto stories making headlines this week. One of the key stories is the Bank of Canada's decision to hold its overnight lending rate at 2.75%. According to at least one auto analyst, this move is not likely to have a significant impact on auto retailing. What are your thoughts on this, Janine?
Well, Steve, it's interesting to see that the auto industry might not feel the immediate effects of this rate decision. While the housing market often reacts quickly to interest rate changes, it seems the automotive sector is a bit more insulated, at least in the short term. This could be reassuring for those in the market for a new vehicle, knowing that financing costs might remain stable for now.
That's a great point, Janine. Stability in financing costs can certainly be a positive for consumers looking to purchase vehicles. But moving on to another story, the U.S. Insurance Institute for Highway Safety, along with the Traffic Injury Research Foundation, released a study showing that traffic fatality rates remain high in the United States while they've decreased in Canada and other countries. What do you think is contributing to this difference?
It's a complex issue, Steve. There are many factors at play, including differences in traffic laws, enforcement, and public safety campaigns. Canada has been actively working on improving road safety, and it seems these efforts are paying off. It's heartening to see a reduction in fatalities, as it reflects the effectiveness of these initiatives and the importance of continued focus on road safety.
Absolutely, Janine. Safety on the road is paramount, and it's encouraging to see positive outcomes from these efforts. Now, another major development in the Canadian auto market is Go Auto's decision to exit Ontario. This is a significant move, and it could have implications for both consumers and the industry. What's your take on this?
The departure of Go Auto from Ontario is certainly a big shift, Steve. For consumers, it could mean fewer options when it comes to dealerships, which might impact pricing and availability. From an industry perspective, it might lead to some realignment as other players step in to fill the gap left by Go Auto. It's a reminder of how dynamic the auto market can be, with companies constantly evaluating their strategies and footprint.
That's right, Janine. The auto industry is indeed dynamic, and such moves can reshape the market landscape. It's crucial for consumers and industry professionals alike to stay informed about these developments. Well, that wraps up our discussion on the top Canadian auto stories this week. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.